Good morning. My name is Josh Blevins, and I am the chairman of Back Row Capital. Let me introduce you to my team, Ryan, Jose, Dean, and Larry, and our sixth member, Luis, had to fly out this morning for a family emergency in Venezuela, so he's not here with us today. As you know, we are the portfolio management team for Renaissance Realty. We're happy to be here today presenting to the Limited Partner Investment Advisory Committee. Our fund has had great success over the last 3 years, but given changes in the macro environment as well as some of our internal portfolio dynamics, we think it's a great time to make a pivot away from some of our current assets and double down in others.
So we are going to focus on three main things throughout this presentation. One, economic conditions. Two, investment scope. And three, where we're going to be putting our investments. So in terms of economic condition, just to speak very broadly, we recently had a rate cut, and we expect future rate cuts to come. This would obviously increase residential development. However, we strongly believe that housing valuation and cash flows will remain stable and growing in certain sectors. This is largely due to the supply and demand dichotomy for residentials. Additionally, we have higher construction costs and higher supply costs. Moving to our fund portfolio and snapshot, we want to diversify our holdings in the US in core and growing markets. However, we want to do this conservatively without too much LTV. The reason why is our main purpose as a fund is to have liquidity for redemptions as well as capital to redeploy when the time is right in a strategic way. In terms of areas where we want to deploy, we mentioned three here, which we will dive deeper in the presentation. Build to rent, we want to increase our exposure there. Manufactured housing, specifically rent to own, and self-storage, specifically climate controlled. So a quick overview of the fund, as you guys have probably heard many times today already. We are an open-ended investment fund focused on residential assets. We're about 3.2 billion GAV, and we're currently levered 57% with a 60% LTV cap. We're pretty liquid at the moment. We have $75 million in cash reserves, as well as an unencumbered line of credit. Now, some quick facts about our investment focus. We have a max 25% development and a max self-storage allocation of 10% with a target levered IRR of 9 to 11%. As you see in our pie chart over here, we're highly allocated in three areas: student housing, mid-rise, and high-rise and garden-style apartments, accounting for over 75% of our portfolio.
Now we're going to analyze the market fundamentals that led our decisions today. Unemployment was in 4.3% in July and went down to 4.1% in October. Overall, these are historically low figures of unemployment, which is a very good indicator for the asset markets. Right now, the inflation rate is very close to the Fed's goal of 2%, which is why they decided to decrease the interest rates by 75 basis points. We divided the analysis of our cap rates in 4 different time periods. Right after the financial crisis from 2010 to 2019, as the economy recovered, interest rates started going down and the cap rates started compressing. During the pandemic COVID-19, what we realized is that the multifamily sector is a very robust and resilient one, and the government also provided stimulus packages. From 2022 to 2023, we saw inflation started to increase and interest rates were raised by the Fed, which means that the cap rates also expanded. However, from 2024 going forward, we expect the cap rates to stabilize or to decrease. We expect cap rates in cities like Houston, Dallas, and Charlotte to continue to be higher by at least 1 to 1.5%. The economic trends continue to favor renting over home ownership. Right now, there is a cost gap of $1,200 per month, which means that people continue to favor renting over owning a property. Right now, a mortgage is 53% more expensive than the actual rate for existing mortgages. Quarterly demand increased by 134%, which is 117% above the long-term average. Vacancy rates went down from 5.9% to 5.6%, which is getting closer to the long-term rate of 5%. Supply was peaked in this quarter at 163,000 units delivered, However, we expect the supply to continue going down in the following years. Household formation over the last 10 years has been steadily increasing, which has helped the absorption of the multifamily sector. Now, for the headwinds, we have construction costs has been increasing steadily. Last year, in 2023, it increased by 5%, and this has been largely due to shortage in labor and increasing material costs. Even though we expect the supply overall to continue decreasing, in specific markets like Miami, Charlotte, and Austin, we expect the supply to continue to be high, which can lead to high vacancies and overcompetition.
So just a high-level overview of our investment portfolio. As you know, we're invested widely across the residential sector. We're fairly agnostic as to individual product types, and we invest across the development life cycle as our portfolio reflects. We can also invest up to 10% of our portfolio in self-storage, and we're currently at about 3% there. As we invest, we're always looking to maintain that sacrosanct 9 to 11% IRR.
So now we'll take you through each of the sectors of our portfolio and provide a recommendation for what we propose the fund should do to reallocate capital and improve returns. We bucketed every single one of our assets into three main groups. The first being a hold, which means we'll refinance the existing loan and hold it in the portfolio for positive cash flows. The second being an increase of exposure, meaning we're bullish about a market or we believe there's an opportunity to increase our current position and generate more value and more ongoing cash flows for the fund, or an asset class that we believe that we should sell either now or upon stabilization or at a target date. Starting with the Sunbelt apartments, the Texas markets have seen a dramatic increase in supply, and we sensitize the timing of an exit in the Texas markets from today until the end of a 10-year cash flow, and it made the most sense for us to hold from a return standpoint. We have a refinance coming up in a year. We're going to have to infuse equity into, given debt yield constraints, refuse equity into the refinance in order to make our loan balance. So an exit right now would be a pretty substantial negative drag on fund returns. Sunbelt Apartments in Charlotte is a completely different story. We're extremely bullish about the Charlotte market. Charlotte is a top 3 growing city in the United States. It's emerged as a top 3 finance hub. I think it's second after New York City. So this is a market that's seen a lot of population migration into the city. There is a lot of supply, but we believe that the oversupply of the market right now will tamper down as the demand curve catches up, and this will be a long-term cash flowing asset for us in the fund. Gateway City Apartments in California is our first major sell. We don't want to be in the business of doing uneducated underwriting. This is an extremely big position for us, and insurance premiums are just, it's everyone's guess on where insurance is going to go. And this has if the insurance costs go up too much in the California portfolio, it could have an extremely negative impact on not just this asset, but on the fund in total. We have some immediate cash needs. When we underwrote the portfolio, we had $100 million of immediate cash needs, including the redemption. So we see this as an opportunity to de-risk by exiting the high-rise market in California, take advantage of the high transaction volumes occurring there right now, and reallocate that cash into higher performing assets in the fund. Gateway in the Northeast is completely different. The Northeast markets have an extremely high barrier of entry. Boston alone has a 3-year entitlement process with a 20% affordability requirement. New York is as of right zoning, so it's a little easier to get projects built, but land values are extremely high and construction costs are extremely high. So the fact that we have cash flowing projects in the Northeast market is something we want to keep. It provides a lot of positive cash flow for the fund that we can reallocate into other asset classes. Student housing is our biggest exit. The student housing supply is completely oversaturated in our opinion. Of the top 50 markets for student housing growth, 10 of them are either SEC or ACC schools, which is where our assets are based. Student housing it's an arms race to have the best amenities, and when you don't have the best amenities, you fall behind pretty quick. We don't want to be in the market of continuously doing value-add projects in order to keep our student housing projects relevant. We want to sell this, get a considerable amount of cash in year 2, and reallocate that cash into a more stable asset base. Speaking of a more stable asset base, build-to-rent is something we're extremely bullish about. Build-to-rent in Texas and build-to-rent in Georgia, because of the macroeconomic trends that Jose mentioned, housing affordability is extremely difficult in those markets, and build-to-rent gives people the ability of having home ownership or living in a home that represents a traditional neighborhood without having to deal with the high interest rates of a mortgage. So we're bullish in these, and we'll explain the investment that we're going to get into on those. Manufactured housing is another industry that we're interested in increasing our exposure into. Manufactured housing is the most affordable housing option to rent as a consumer, but it's also the most affordable housing option to build as a developer. On average, manufactured housing costs about 35% of a comparable sized home. So we see this as diversification in our residential portfolio. If there are any trends that impact the residential markets, manufactured housing being, sort of the bottom of the ladder, will still be positive cash flowing for us because demand will increase in that instance. And then last but not least, self-storage. We're currently at a little under 4% of our GAV is in self-storage. We want to increase that closer to 7% by making a strategic investment in year 1 upon the sale of the student housing asset. Self-storage, it's a diversification play for us, but it's also very predictable if it's built in markets with, promising multifamily trends. And given the inflation rate environment, people can't build homes. People don't have the garage. They're forced into apartments, so they need a storage unit. So if you're strategic on your location, self-storage is something that can be extremely predictable and extremely positive cash flowing. So in conclusion, our responses to the macro trends are really, there are 4 buckets here, but it's really 2 main buckets. One is to dispose of some high-risk assets such as student housing and the gateway apartments in California. The second is to reallocate and stabilize the fund by deploying that capital, those proceeds, into asset classes we want to be more exposed into, refinancing our holds. And we're doing all of this without touching our credit line. The credit line for us is a low-rate sort of loan bonus that we'll keep in our back pocket in case there's an additional sector we want to get into that we don't have the proceeds for, or refinance that we don't have, the equity infused into the fund for, or what have you. That's a for a rainy day loan opportunity for us that we're not going to touch at this time.
Quick high-level snapshot on some of the buys that we're making. Self-storage in Florida, we're buying 800, or self-storage across the country, we're buying 800 units on about a $100 million capital outlay. An IRR of 14% obviously beats the fund average. 5-year pro forma we have for all of these properties that we'll be seeing. Build to rent in Texas and Georgia, 800 unit, we'll do this in 2026. About another $100 million TDC, a levered IRR of 16%. Manufactured housing in Florida, our second largest buy. We're going to try to acquire 2,500 units of stabilized housing at a proposed acquisition cost of $360 million, a levered IRR of 10%. And finally, a Charlotte market purchase, 2,500 units. This is a value add play. We'll spend about $560 million on it, generating a levered IRR of 11%.
So we're going to briefly discuss some of the portfolio financials. So here you can see kind of juxtaposed our year 0 and year 5 asset allocations across the different sectors. You can immediately see the impact of on our net asset value, the exits and strategic capital recycling program that we're doing and investing in projects that more closely align with our investment thesis. So we're growing our self-storage allocation here in year 1. And as you can see, by exiting the Gateway City Apartments in California, reducing our exposure there, and chasing after more strategic, opportunistic markets in build to rent and value add, we're increasing our development portfolio there and really maximizing as best we can our self-storage capacity. It's important to note here as well the debt yield requirement on our refinancing activity for our existing portfolio does place a constraint on our ability to really lever up, especially for our existing portfolio. We're confident that the forecasted changes in the debt capital markets will allow us to stabilize with more accretive financing in the near future. So here's a quick roll-up snapshot of our portfolio returns. We based our operating assumptions off of, in part, what was provided to us in the case, as well as some of the market fundamentals that we were seeing in our market research. We underwrote a conservative 11.17% levered IRR by including our acquisitions and our strategic sales in years 1 and 2. We sensitized the expansionary cap rate environment as well as our investment horizon to arrive at some of the hold assumptions that we were seeing, both on a project basis and also rolling it up to the financials. And we're confident in this number, and we certainly feel that once some of our higher capital intensive projects, such as build to rent, stabilize and are absorbed, that we'll be able to take advantage of more opportunistic debt capital markets to secure more accretive financing, as I just mentioned. So here's a timeline of what that debt to equity looks like, as well as the LTV. So again, these capital intensive projects, especially the build to rent, we understand the implications on how that will impact our total leverage. But once these projects do stabilize, we're confident that beyond the 5-year time horizon, we'll really be able to see a high levered return. And lastly, we just wanted to share a quick snapshot of our sources and uses. So 3 things to point out here. 1, the major changes in our balance sheet are really occurring in the first 2 years as we exit the Gateway City Apartments in California and the student housing project that frees up a tremendous amount of liquidity to be able to chase after new deals. Years 4 and 5, we see the return of our cash flows from operations to return high cash on cash return for our investors in perpetuity. And lastly, we modeled capital contributions in line with our redemptions on a go-forward basis. We modeled in a generous liquidity amount as well. In the case that those contributions fall by the wayside, we'll still be left with in excess of $20 million annually for any unforeseen capital expenditures, as well as if we want to flex on any of the new acquisitions in case market fundamentals change.
So, in conclusion, we have a clear and primary goal in 3 areas. 1, we will refinance our stable assets that produce stable cash flow. 2, we will invest in areas that we believe that have strong growth due to secular and macro trends. And 3, we will divest in assets or markets that we believe have reached maturity in terms of their lifeline. We have a 11.17% IRR, which is above our 9 to 11% target. It's very accretive and it's great. But what's mostly important is that we did this with very moderate and conservative leverage, as well as having ample liquidity within the fund. This gives us a cushion to pivot strategically, dynamically into a different market or strategy if the market changes, as well as facing and combating any unforeseen risks. We are Back Row Capital, and we thank you for your time. We thank you for your attention, and if you have any questions, please ask.